The coming years are going to move a lot of money from one set of hands to another. Some of that will be because of age-older owners passing on, estates liquidating, families simplifying. Some of it will be because of fear people getting uncomfortable with volatility and selling things they don't understand. You can call this a wealth transfer if you like. All that really means is a lot of assets will change owners at prices some people later regret and others later celebrate. If you're asking, where should I move my money before mid-2026? You're asking a better question than most, but don't expect me to give you 3 ticker symbols and a calendar date. That's not how I think. When I look at a period like this, I don't see stocks and bonds and crypto. I see business models. I ask, which kinds of businesses will still be earning good money 10, 20 years from now, even if inflation stays around, even if capital gets nervous, even if people are forced to sell? The answer, to me, is simple. You want to own things that behave like toll bridges, like good farmland, and like small essential monopolies sitting right in the middle of local life. Let's start with toll bridge businesses. Years ago, I said that in an inflationary world, an unregulated toll bridge would be a wonderful thing to own. You lay out the capital once in old dollars, you don't have to keep rebuilding it, and then as prices rise over time, you simply adjust the toll. The bridge doesn't complain. The cars still have to cross the river. When I talk about economic moats, that's what I have in mind. A business you build once, more or less, and then it sits there and throws off cash because customers don't have a better alternative. These days, a toll bridge doesn't have to be a literal bridge. It can be the only newspaper in town. It can be the dominant payments network or the default software everyone's trained on, or a brand so strong that people pay up without thinking. The key ingredients are the same: high returns on capital, low ongoing investment needs, and the ability to raise prices without sending customers running for the exits. When I say I love pricing power, that's what I mean. If you can raise prices 5-10% and still keep volumes and loyalty, you've got a moat. If you have to run discount campaigns every time you nudge prices up, why does that matter heading into 2026? Because in any period where inflation bites and older investors are drawing down portfolios and institutions are juggling their allocations, the businesses that can quietly increase prices while holding on to customers are the ones that preserve and grow real earnings. A weak business has its margins crushed by higher input costs and interest expense. A strong toll bridge type business just tweaks its price list and carries on. In an environment like that, money tends to flee from fragile, capital-hungry enterprises and drift toward the durable cash machines. If you already own them, you're in the shelter when the storm starts. Now the second shelter, productive land, especially good farms in stable regions. In one of my letters, I talked about a 400-acre farm I bought back in 186, about 50 miles north of Omaha. I didn't buy it because I wanted to be a farmer. I bought it because I could look at the numbers, how many bushels of corn and soybeans it would produce, what the operating costs were, and what kind of yield on my purchase price that represented. Decades later, that farm was producing far more income than when I bought it, and the land itself had risen substantially in value. I didn't check its quote every day. It just sat there, soaking up sunlight and rain and turning them into cash year after year. That's what I like about farmland and essential real assets held at sensible prices. They don't care who's president or what the Fed is saying this week. They care about weather, productivity, and long-term demand for food and space. In a world where a lot of wealth is just pixels on a screen, actual productive land gives you something old-fashioned and sturdy. Of course, you can overpay for land just like you can overpay for any asset. I don't recommend buying into a bubble, but if you can buy high-quality farmland or similarly productive real estate in a region with decent rule of law and predictable property rights, and you get it at a price where the cash yield makes sense on day one, that can be a very comfortable place to park capital through a wealth transfer. Think about what happens when older owners start selling. Some will liquidate farms and properties because their heirs don't want the hassle. Some will sell after a downturn because they've lost their appetite for volatility. Institutions may sell because of some policy written by a committee. In those moments, buyers with patience and cash can pick up good land and solid properties at better prices than they could when everyone was excited. You don't need to guess the month or the quarter. You just need to know roughly what a farm is worth based on what it produces, and then be willing to wait until the price wanders below that line. The third shelter is what I'd call essential local monopolies, the little economic castles all around you. These aren't always the glamorous tech names or the multinational giants. Very often they are the only meaningful water or sewer utility in a region, the main quarry or cement supplier in an area that's building roads and houses, the regional trash hauler everyone relies on, a specialized distributor that every restaurant or clinic in town depends on. If you shut them down, people notice immediately. They don't show up on social media, but they show up in real life. I've compared owning a dominant local newspaper in its prime to owning an unregulated toll bridge. Readers and advertisers had very few alternatives. If they wanted to cross that river of information, they had to use your bridge and pay your toll. The same logic applies to a lot of these small monopolies. The moat might be regulation, heavy infrastructure cost, long-standing contracts, or the simple pain of switching providers. Whatever the mix, the result is the same. Customers stay, cash keeps coming, and modest price increases are tolerated. In a big wealth transition, a lot of these quiet little castles will come up for sale. An owner in his 70s wants to retire, and his children would rather have cash than run a quarry. A local family that has run a utility or service business for generations finally decides to step aside to their heirs. It's a headache. To a thoughtful buyer, it's a chance to own an asset that sits right in the flow of local life and collects a steady toll. If you have the competence to evaluate and run or hire managers to run those enterprises, they can be some of the safest, most rewarding places to park capital over decades. So if we put all this together, what does move your money to these three places before mid-2026 actually mean? It means this: start reweighting your life away from things that rely on constant optimism and towards things that make money in almost any weather. Ask yourself three questions whenever you look at a potential investment. First, does this business have a real moat brand cost advantage network regulation that lets it maintain high returns on capital over time? If it doesn't, I don't care what the spreadsheet says for next year. Without a moat, capitalism will chew away those returns sooner or later. Second, is this asset genuinely productive, or am I just hoping someone else will pay me more for it later? A farm that yields crops is productive. A toll bridges style company that consistently earns high returns because of a durable moat is productive. A local monopoly that sends you cash distributions year after year is productive. A thing that only looks good when someone else is more excited than you are is speculation. There's nothing illegal about it. But don't confuse it with a shelter. Third, if I owned 100% of this business or asset and the stock market shut down for 10 years, would I be happy to keep owning it? That's the real test. If you can say yes because you trust the moat, the pricing power, the productivity of the land, the essential nature of the service, then you don't have to stare at quotes all day. You can let the world argue about recessions and elections while your toll bridge, your farm, and your local castle keep doing what they were built to do. The wealth transfer is not something to fear. It's just a description of who is likely to be buying and who is likely to be selling in the coming years. Older investors will sell what they no longer wish to hold. Their heirs will sell what they don't understand. Institutions will shuffle assets around to satisfy some policy. If you quietly make sure that more and more of your money lives in three kinds of places, toll bridge businesses with real pricing power, productive land in sensible locations, and essential local monopolies with wide moats, you won't need to predict the headlines. You'll just need to own good assets and wait while the world slowly hands them to you at fair prices.